Here's the view from Goldman Sachs and Zach Pandl. They write the following. We do not see major risks of a second wave in the US or other large economies, and our economists forecast a relatively steep rebound in activity over the next few months. This should allow for a continued pro-cyclical rotation across assets and renewed dollar depreciation. Zach Pandl of Goldman, I'm pleased to say, joins us on the phone right now. Zach, appreciate your patience over the last couple of minutes as we get you connected. Let's talk about the correlation between risk appetite and dollar depreciation. You expect this to be the direction of travel for the foreseeable future, Zach?
Yes, I would expect that to remain the case for some time. The dollar is negatively correlated to the health of the global economy and investor risk appetite, and that reflects a variety of things, including the dollar's traditional safe haven role, as well as its function as an international currency. So, all else equal, a recovering global economy, rising risk appetite, rising risky assets should be associated with dollar weakness, and that's a key feature of our views at the moment.
Zach, all makes a lot of sense. I just wonder where the euro slots into this view for you. Going into the pandemic, the euro was increasingly being used as a funding currency to take exposure elsewhere in EM. For that reason, the euro was almost bid in the bad times and on offer in the good times. I'm just wondering how you think that story is going to evolve in the coming months.
Yeah, it's a great question. We think that euro-funded carry trade that was a prominent feature of the market early in the first quarter of this year has essentially been washed out. We don't really see that pattern that you're describing where when we have extreme risk off, the euro is bid because of the closure of those carry trades. We don't really see that in the market today. And one reason for that is that the yield difference between the U.S. dollar and the euro is pretty small. So investors that are trying to get long EM assets or other high-yielding currencies are more or less indifferent here, at least from a yield standpoint, between the dollar and the euro. So I don't think that the euro is really a natural funding currency per se anymore, and we would prefer the dollar as a funding currency, but I think most investors would either prefer the dollar or be close to indifferent between the two at this stage.
Zach, it's been really interesting to see how much more constructive people have been on the single currency in the last month or so, primarily because of what they see on the horizon in terms of the policy effort. I see a real dislocation. What's good for the economy right now is a timely response and size in Europe. And what market participants are encouraged by is putting together a mechanism that might be used for the 6 months to have some kind of fiscal transfer. And that's why they're driving the euro higher. I just wonder, can we drive the euro higher if we're going to have to wait 6 months to see the stimulus hit the ground at a European level?
Yes, you can see the euro move higher well in advance of the recovery fund actually spending money in the euro area. I think that in addition to there being a bear case for the dollar, there is also a bull case for the euro, in my view, that reflects its cheap valuation, but also the recovery fund, which reduces tail risk for the euro area as a whole, and also just like the macroeconomic fundamentals. I mean, I think we should acknowledge that the virus is a bit under better control in the euro area. The unemployment rate has risen by much less than it has in the U.S., so there are some features of the euro area which is outperforming the United States. So I do think that there is this bullish Europe argument, and I think we could see and will continue to see euro appreciation well in advance of those recovery fund resources actually being deployed.
Zach, what kind of levels are you thinking about and over what time horizon?
Yeah, so I think at this point, the euro appreciation probably remains relatively gradual. So we're not writing a very steep appreciation path down just yet. And the main reason for that is that we think that equity investors in particular are going to be relatively gradual in redeploying capital out of the U.S., out of the tech stocks that have outperformed for a long time, and into the sort of cyclical type companies that dominate European exchanges. So that probably keeps the appreciation trend relatively gradual. So where are we heading? I think fair for euro dollar in the medium term is around 130. So that's the kind of target I would have in mind if we have a structural downtrend in the dollar really taking hold. That's not an unreasonable level to anticipate over the next couple of years. We don't think that we're going to reach 130 anytime soon, but that's a kind of medium-run fair value that I would have in mind if the dollar does begin weakening on a more sustained basis.